Ladies and gentlemen, good day and welcome to the Q2 FY2024 earnings conference call of E2E Networks Limited, hosted by Valorem Advisors. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Purvangi Jain from Valorem Advisors. Thank you, and over to you, ma'am.
Good evening, everyone, and a warm welcome to you all. My name is Purvangi Jain from Valorem Advisors. We represent the investor relations of E2E Networks Limited. On behalf of the company, I would like to thank you all for participating in the company's earnings call for the second quarter and first half of the financial year 2024. Before we begin, let me mention a short cautionary statement. Some of the statements made in today's call may be forward-looking in nature. Such forward-looking statements are subject to risk and uncertainties, which could cause actual results to differ from those anticipated. Such statements are based on management's belief as well as assumptions made by and information currently available to the management. Audiences are cautioned not to place any undue reliance on these forward-looking statements in making any investment decisions. The purpose of today's earnings call is purely to educate and bring awareness about the company's fundamental business and financial quarter under review. Now let me introduce you to the management participating with us in today's earnings call and hand it over to them for their opening remarks. We have with us Mr. Tarun Dua, CEO and Managing Director, and Ms. Megha Raheja, Chief Financial Officer. Without any further delay, I request Mr. Tarun Dua to start with his opening remarks. Thank you, and over to you, sir.
Thank you, Purvangi. And thank you, all of you, for joining us today. Firstly, let me wish all of you a very happy Diwali and a happy New Year. And welcome to our earnings conference call for the second quarter and the first half of financial year 2023-24. Before we begin with the performance for the second quarter and the first half of the year, let me give you a very brief introduction about the company for some of you over here who might be new to the company. E2E Networks was founded in the year 2009 and is today amongst some of the largest public cloud players in India. We have carved a niche for ourselves by providing cloud services to businesses across various workloads, including artificial intelligence, machine learning, workloads targeting application developers, enterprise customers trying to run CRMs, ERPs, and we operate within the infrastructure as a service or IaaS model, delivering the cloud computing, storage solutions for various workloads, including databases for load balancing, virtual firewalls, and simple queue service, Kubernetes, and many other cloud-native platforms. So we listed on NSE Emerge in 2018. And more recently, we transitioned over to the main board of NSE in 2022. Over the course of our evolution, we have significantly expanded our customer base, and currently we are serving a very robust customer base of over 2,600 plus active customers. We operate out of data center facilities in Noida and Mumbai. A much more comprehensive list of our product offerings of various types of cloud instances and other cloud services that we provide are also available on our website and our self-service cloud platform at myaccount.e2enetworks.com. In the current landscape, we have seen an increasingly new workloads in the AI/ML domain, and these are like completely new workloads which are not replacing the older workloads. Like these are the workloads that are the workloads of the future. And this in itself presents like a substantial opportunity for us to work in an area which is like very new and where we are quite at par with our competition in terms of like the software and technology that we have built. So there is an ongoing transformation, digital transformation in the entire enterprise and organizational space, especially towards the public cloud. And India itself, like we have seen in like some of the recent industry reports, that like is witnessing a surge in the overall data center capacity. So that is expected to grow by over 10x over like next 5 years or so. Now, we are very uniquely positioned as a Indian player out of India with like bleeding edge native support for artificial intelligence, machine learning, and deep learning workloads from the get-go. And we have a history of providing very high value solutions compared to their price. So very cost-effective and value-centric solutions compared to our global hyperscale cloud players who compete with us. The demand for AI/ML workloads is on a rise, and that is driven by various sectors, including higher education and research. There is also an impetus to this sector for localizing their data because of sectoral regulations and the needs of like implementing like data protection requirements. The company has like offered very competitive pricing in this particular domain, and we are very advantageously positioned in terms of like price performance ratio, and it becomes like very attractive for our customers. So we anticipate like our company to be able to grow anywhere between like 40 to 50% over the medium term over like next couple of years. The company has successfully transitioned to like a self-service model since our IPO, and today almost 80% plus of our customer base uses our self-service public cloud platform. This distinguishes us from our smaller domestic competitors and makes us very similar to the global hyperscale cloud platforms. The self-service model allows the customers flexibility in spending and contributes to like the scalability of the product for the customers and increases like customer satisfaction. And the self-service model like really sets us apart in terms of the cloud services landscape in India, where apart from the MNCs and the MNC hyperscalers, nobody else is offering like a complete self-service and billing model to their customers. During the second quarter of financial year 2024, we have launched and made very rapid progress on many new services and features. We have released some of the newer features on our AI/ML platform called TIR, which is a workload environment both for training and inference on AI and ML workloads. And this allows customers to run their AI/ML workloads from the get-go by simply making sure that they are able to upload the data at the right place. And the inference features released on TIR helps in standardized endpoint deployment for the models and in a scalable fashion, and that allows like the customers to save a lot of time. So we have also released a datasets feature on our TIR platform with an option to quickly mount the datasets for creating the workloads around those datasets, either for training of the models or for delivering the inference. More recently, we have also launched the committed node plans on our TIR platform, that allows for customers to be able to cut down their costs by prepaying for longer periods of time. On the cloud native side, E2E container registry was launched for customers, and that really helps with the cloud native Kubernetes and Docker container features. And customers can also clone their existing registries if they are already available with them, instead of building new ones. And new compliance and security features were launched with additional monitoring capabilities for early warning of potential telltale signs of intrusions or vulnerabilities, and compliance monitoring of the nodes. So on my account, our self-service platform, the additional features that were added to the scalable file system product was the ability to snapshot, resize, clone and backup the volumes on the scalable file system. So we have broadly explained who we are, what we do today, and the kind of innovation we are doing today. Overall, we remain very, very confident of the overall industry scenario and the positioning of our company in this new scenario of an AI-first world. And our performance continues to remain very strong currently. And now I would like to hand over our call to our CFO, Megha, to brief you on some of the key financial and operational highlights of the quarter under the review. Over to you, Megha.
Thank you, Tarun, and good evening, everyone. I will summarize the performance for Q2. For Q2 financial year of 2024, the company has reported consolidated revenue of 21.6 crore INR, which grew by 31% year-on-year. Our EBITDA stood at around 11 crore, which grew by 35% year-on-year, representing an EBITDA margin of 51.85%. Profit after tax, PAT, was reported at around INR 6 crore, which is more than double year-on-year. The PAT margin was reported at 26.85%. Now I will come to H1 performance. For H1 of financial year 2024, the company reported consolidated revenue of around INR 41 crore, which grew by around 30% year-on-year. Our EBITDA stood at around 21.4 crore, which grew by 37% year-on-year, representing an EBITDA margin of 52.07%. PAT, profit after tax, was around 13 crore, which we grew by approximately 146% year-on-year. The PAT margin is reported at 31.14%. Our revenue growth is a function of consistently increasing the monthly recurring revenue. We continue to maintain healthy operating margins and generate robust cash flow. That concludes the updates on the quarter, and we can now open the floor for question and answer session.
Thank you very much, ma'am. We will now begin the question and answer session. Anyone who wishes to ask questions may please press star and one on the touchtone phone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, to ask questions, you may please press star followed by one. The first question is from the line of Sanika Khemani from Sapphire Capital. Please go ahead.
Hello, sir. Hi, my question is regarding the profit margin. So, whatever profit
ma'am, your audio is feeble. Could you please increase the volume a little bit?
Yeah, is it fine now? Am I audible?
Yes, ma'am. Please continue.
Yeah, so actually my question is regarding the profit margin. So like a lot of it has come from the change in the depreciation policy. So like my question was, what kind of PAT margin can we expect after we get in the operating leverage and everything? And what kind of depreciation can we expect going ahead? Like what is the depreciation trajectory?
Sure. So, broadly, over the course of time, I can't comment on quarter or year on year.
Yeah.
Broadly, over a long term, medium term, long term, we are targeting, say, 15 to 20% PAT. But I would let Megha answer the questions about the depreciation that you have asked.
Okay, sure. So we changed the method of depreciation from WDV to SLM from June 2023. And the impact of the same, and this new change of depreciation is as per Schedule 2 of Companies Act. The impact of change is also disclosed. For H1 it is around 5.6 crores and for Q2 it is 3 crores.
Okay. And, okay, fine. Thank you.
Thank you. Participants who wishes to ask questions may please press star followed by 1. The next question is from the line of Kshitij Saraf from Tusk Investments. Please go ahead.
Yeah. Hi, good afternoon. Many congratulations on the results and thank you for the very detailed explanation of your business in the presentation. Just wanted to know on the H100 chips now coming in, how do you see the margin profile for this business, and is it going to be any different from the traditional workloads you've handled, both in terms of at an operating level and at the capex payback level?
Okay. Thank you, Kshitij, for your kind words. So let me try to answer that question in multiple parts. So the number one part is whenever someone is using say an H100 or a GPU instance, they would also use many other services over our cloud platform. So typically it is hard to predict the blended effect of the margin profile overall for any customer by simply looking at the headline workload that, this was primarily an H100 workload, so this would be the margin profile for the infrastructure being used by this particular customer and so on. Then there is also a lot of impact in terms of how much prepayment a customer has done, for 1 year, for 6 months, for 3 months, and the total volume bought by a customer. So whether the customer is a larger volume or whether they purchase a very small volume, so the pricing could vary because of that. But all of that being said, the H100 would have a slightly lesser margin by a couple of percentage points compared to, say, an A100, because this is a more expensive GPU. Now, that being said, it is not uniformly true. In case a typical customer uses a much larger cluster, then potentially the margin could actually be higher than an A100 as well. So broadly, we don't expect it to massively differ from the overall margin profile that we have overall with the introduction of new workloads based on H100. We don't think there is going to be a massive difference. Although there is definitely a possibility of a few percentage points of margin being different for some of the headline products. But whether that would actually result in an overall difference to the overall company or not, that is very, very hard to say.
Got it.
I hope I'm able to answer your question.
Yes, absolutely. That's very helpful. And secondly, because it's a self-service model and users can opt in and opt out at any time, there is a lot of flexibility for the user. At the same time, because the user can drop out at the same time, this would mean a lower sort of lifetime of a customer. However, I mean, the growth has been very good, and the industry is in an upswing, and you're witnessing very robust growth. So how do you sort of navigate this whole piece?
See, we have always maintained that being flexible as a cloud, as a public cloud, is the key for the customers to have the confidence to run and scale their workloads on the cloud platform more easily. So if we do not offer any flexible options, on the other hand, we are also happy to offer longer term contracts to the customers, financial contracts to the customers who want them at a slightly lower price. But the primary mainstay of any public cloud is obviously the flexible part of the plan. Now, that being said, typically we observe that the lifetime value of a customer does not reduce because of offering flexibility. Because of the flexibility, the lifetime continues to increase. Now, that might just mean that the workload is spiky, but then across many thousands of customers we have, that kind of evens out at a overall cloud level.
Got it. Thank you. That's very helpful. Congratulations again.
Thank you.
Thank you. You may please press star followed by 1 to ask questions at this time. The next question is from the line of Hasmukh Visharia from SUG Live. Please go ahead.
Yeah, hi. Thanks for the opportunity and congratulations on a good set of numbers. I have a couple of questions. So firstly, if you can, let's say, give some qualitative data around what would be, let's say, difference in terms of pricing between our, let's say, cloud services versus the other peers?
So the presentation actually mentions a few SKUs around pricing for very similar SKUs on our cloud platform versus the MNC hyperscalers. So some of those examples are there out there in the main presentation. Typically, the price that we offer varies between, say, 30-35% of a similarly priced SKU on a MNC hyperscaler platform, and maybe sometimes it all goes all the way up to maybe 50% of that price. So, but typically we are about 50 to 60% cheaper overall compared to the large hyperscalers.
Okay. So if I try to, let's say, look at a major differentiation for you versus peer, so apart from, let's say, pricing, what are the other factors or, let's say, features you can call out which would be make you differentiate versus peers? Yeah.
Sure. So, we have, so what we maintain is that, basically, we are building our software to align with the needs of our customers. So, which means that every cycle of our software releases every quarter improves the product market fit for our product, and we build and improve on the features that are most used by our customers or most demanded by our customers. And over a period of time, that creates its own niche in the category, where people who become familiar with our software and kind of expect certain things in our software, they tend to want to continue to use the software over a period of time. So that creates longevity for the customers essentially.
Okay, understood. And lastly, so as I understand, you might be having, or majority of your customers would be into MSMEs. So if you can highlight what are you doing to, let's say, get larger clients onto your platform or onto your cloud platform. So any strategies behind
that? By numbers, the majority of our customers are MSMEs and startups. But what we have seen increasingly is that like our customer base is driven by the workload rather than by the size of either their company or our company with a view to use our services. So like we are no longer exclusively focused on MSMEs. So we have built the features over like past 5 years since the IPO, where every year like we have seen that like larger customers with a larger ARPU are able to utilize our self-service platform to kind of like build their production-centered cloud infrastructure on top of our cloud, and they continue to use and increase their usage of our cloud platform.
Okay. So will it be possible for you to, let's say, call out what would be, let's say, top 10 clients, revenue share for you? Any sense on that?
I don't have the offhand data about all of these things. And like, of course, like if we publish those things, then like we'll publish them for everyone. Otherwise, like if it is generally not available, like we'll kind of like not put it out over here currently.
Got it. Thanks for it. That's it from my side. Thank you.
Sure.
Thank you. You may please press star followed by 1 to ask questions. The next question is from the line of Sanika Khemani from Sapphire Capital. Please go ahead.
Yeah, hi. Thank you for the follow-up opportunity. I just want to understand, why are we expecting a drop in the PAT margin in the medium term?
See, very hard to predict these things. So, like we are not like super great at like forecasting like kind of like over the medium term. So, but like over the like long term, like I don't see like us kind of like going down on either EBITDA or the PAT. Like I think like over a longer term, like we should be able to maintain those. The reason for that is that like basically as we keep building more value into our software that we are providing to our customers, the newer SKUs with a higher value proposition for our customers would have a significantly better margin profile because there would be a bigger software capability component on each of those SKUs.
Okay, fine. Thank you.
Thank you. The next question is from the line of Pratik Chaudhary from Samarthya Capital. Please go ahead.
Hello, sir. Have there been any price changes in terms of pricing per SKU in the recent past?
So Pratik, like typically we do not change pricing of majority of our SKUs, like mostly like unless there is an FM mismatch. The only SKUs where the pricing changes is like typically related to pass-through licensing that our customers license through us. And over there, if the backend license changes, we would change the price of those SKUs accordingly. But typically, once a customer is on an SKU, they have the assurance that they will have the same price for many, many years to come. Now, typically, the pricing on a similar SKU, in a newer generation SKU, could be different because of the reasons that like the underlying hardware was more expensive or less expensive, and there would have been additional features which kind of like work on the newer SKUs. So for that reason, the newer SKUs would have like sufficiently different pricing from the current generation of SKUs. But typically, like for the same SKU, as much as possible, we try to keep the pricing same for many years to come. That creates a stability in the mind of the customer that yes, like once I bought something, the price is not going to change unless like some real major reason for that like happens.
Mm-hmm. Is there any update on our any recent development or change in plan for our capex plan for this year?
We do not have a plan for aligned with the boundaries of the financial year as such. So the overall plan to deploy capacity remains as is basically. So we have spoken about we are going to overall go and deploy say almost 150 to 200 crore rupees of hardware. So over next say 12 months, so 12 could become 15. But broadly that number remains in place.
Okay, and are we also looking to raise equity capital for the same, or it will be purely debt and internal cash flows?
For the current plans, basically debt and internal cash accruals make it possible for us to be able to do that without raising additional equity. That being said, in a super short term, I don't see us raising equity on a very immediate basis.
Any because we have now launched this platform and the platform, AI platform, and our customers will slowly realize its advantages. So in terms of our asset turns, does that, because earlier in your previous call you had spoken about the asset turn number being around 0.7. So does that change in any way, or will that have an upward trajectory over the next few years, say quarters or years?
Obviously, we want it to have an upward trajectory, but it will not change quarter on quarter that much. So the long-term view is obviously that as more and more software features start adding a lot more value to the customers, the asset turn would increase. So currently it remains broadly the same as before.
Which is 0.7.
See, we don't really calculate that number. That is a post-facto number. So what we calculate is we typically look at the overall payback period of anywhere between say 12 to 20 months across the scale, and that varies very, very widely. So ultimately what is important is when you look at it post facto and then say, okay, what was it looking at the past.
Mm-hmm. And the last question, when we look at the nature of these AI workloads for a specific customer, do you see that there's a wide variation in terms of their monthly usage for say if we have to talk about one single customer, because they train a particular AI model, and then but then after some time or does the requirement fluctuate very significantly in different months and quarters for a single customer? Is that how the nature of the AI workload is?
See, Pratik, that used to happen a couple of years back, where the workloads for training customers used to be very, very bursty. Today, what we see is that training has become a continuous workload. So where typically the customers look forward to having the capacity with them for long term to kind of be able to focus on the task at hand rather than trying to say that optimize, do the training and then exit out of this and then move to inference. So that is no longer the case. People have the requirements of training continuously these days.
Okay, sir.
Training has become a much more consistent workload than that was there in the past.
Okay, sir. Okay, thank you. Thanks a lot. All the best for your future.
Thank you.
Thank you. Yeah.
A reminder to all the participants that you may please press star and 1 to ask questions. The next question is from the line of Dipesh Mehta from Emkay Global. Please go ahead.
Yeah, thanks for the opportunity. I am new to the business, so maybe I try to understand some of the basics. First, you indicated about some cost advantage versus hyperscaler for customers as high as 40-50%. So how it helps us to be so cheaper when some of the hyperscaler has very large scale compared to us, and utilization for them would be relatively higher considering concurrency and all those other factors. So if you can help us understand it. Second point is, I think in earlier one of the comments you indicated about medium-term growth aspiration of 40-50%. If I look our H1 performance, it is lower than that number. So at lower scale, our growth is moderate. So whether we have step-up kind of growth phases where your growth in some phases will be much higher than it moderate for some time. So if you can help us understand those kind of tapering off. Third question, I missed about the capex number. If I heard it correctly, you said 150 crore capex plan for next 12 months. Is that number correct?
Yes, so broadly, roughly, that is what we plan. But then the capex
related question.
I'll come back to the question 1 and 2 as well. See, so let me start by addressing the capex part. So capex is also dependent on the global supply chain. So sometimes you may place an order and then the orders get delayed. So very, very hard to kind of pin it on exact timeline. But yeah, broadly, we are looking at that number essentially. So anywhere between say 150 to 200 crores for overall capex in this particular cycle lasting about 12 to 15 months. Now, coming back to the first question, why we have a cheaper pricing compared to the global hyperscalers. So one is that the major reason for that is that we are not doing everything they are doing. So they want to service a customer spending between $5 to $500 million per month across the globe for every possible workload under the sun. In our case, we want to be far more specialized in terms of, number one, the geography we serve, number two, the number of workloads we support, and number three, the amount of spend that we have on the software development, because we are not catering to every possible type of workload at every possible type of scale. So essentially, that makes all the difference in terms of our focus on the niche product market fit suiting our customers in a particular geography. So that actually enables us to have a lower cost structure. Obviously, the hyperscalers have the advantage of the scale. They have the advantage of like you mentioned, a higher utilization. So all that being said, it is possible for a smaller, nimbler, more efficient player to have a lower cost. Now, coming back to the second question, yes, the growth guidance that we are providing is for the medium to long term and does not apply to the quarter-on-quarter or half-year to half-year kind of business that you are looking at. So, yes, we have mentioned that before, and I would like to mention that before today, that the growth is definitely lumpy. If we look at over a next 5-year, 6-year term, we expect to be overall able to do a CAGR of say 40 to 50%. That's the aspiration that we have.
So just want to understand, let's say you said we have advantage of some of these payload differences. So what would be the strength and weakness for us, or limitation, let me put that better word. So in terms of payload, what we cater and what we are not catering to. So if you can provide
we are very, very focused on the AI ML workloads today. And the infrastructure pieces that we have built are very, very focused on being able to deliver on the AI and ML and training workloads. So that's our focus area. And if you look at any typical hyperscaler, they would be focused on doing everything from edge computing, private 5G. The number of workloads in the world out there is unlimited. So, like our focus, very specific focus, is to be make ourselves better for our customers on how to be able to run the AI/ML workloads, which is the reason why we have launched our Tier platform. So, which helps our customers do things like faster from the amount of time that people spend on having to configure and use our self-service platform.
Understand. And the second question is about 150 crore capex which you indicated over maybe 18 months period. Now, if I look your last year capex, it was less than 20 crore. H1 is less than 10 crore capex. So now what you are suggesting, in a way, you are likely to do 7x capex in next 18 months compared to what you spent on FY23. Whether I am comparing right numbers or I am missing something?
See, what you are missing over here is the size of the market opportunity that we are foreseeing over here. So basically, our capex plans reflects the reality of the market today, that there is an expected demand of that scale happening. So we want to ensure that we are able to cater to that demand while being flexible and nimble. So which means that if we see that demand tapers before we have committed to spend that money, we can obviously scale that down. So it's a very optimistic expectation from our side that yes, we do see that if that optimism comes to the pass, we should be able to do that kind of capex.
Understand. And if one assume, let's say 150 crore capex is likely to materialize in next 18 months, then what will be the potential revenue maybe, let's say, we can realize over next 24 months once the capex incurs?
We talk in terms of ARR. ARR is basically a 12-month projection of MRR. So essentially, if we make say 200 crores of overall capex, then that should result in an additional ARR of 120 to 140 crores over and above our existing revenue.
And so what will be the gap between ARR
and revenue? Directly translated to revenue. It translates to future revenue always.
Sir, let's say if I look over ARR and current revenue, what will be the gap between these two numbers at this point of time?
So if you look at the presentation, you can derive the ARR from the MRR that is mentioned for the September month. So multiply that by 12 and you get the ARR. So ARR would always be a leading figure, leading indicator.
No, that I understood. So let's say your revenue for H1 was 41 crore. If I look your September number, it is roughly around 7 crore. So if I do 7 into 6, we get 42 crore. So that's how one should look at it when you are doing this arithmetic?
Sorry, say that again, please.
So if I look your H1 FY24 revenue, it is 41 crore.
Sure.
Now that is 6 months forward. So in a way, if I do only September month ARR, that it matches with the number.
Sure. See, the devil lies in the details. I think you have rounded off 7.2 to 7. So 7.2 results in an ARR of 86.4 crores. And obviously 7 crores leads to an ARR of
84.
84 crores, absolutely. So that is a bit of gap. So that gap can increase when your MRR growth is higher, obviously.
Fair point. And last, which is related to the question which I said, your current growth is slightly lower than your expectation of 40-50 over medium term. When you are relatively smaller, my expectation was growth would be relatively higher, and when you have scale, it should moderate. So what explains this divergence, if you can help us understand? Thanks.
The capacity build-out on infrastructure side takes time, and obviously there have been delays in the overall global supply chain for the primary products that we buy. So that is the major explanation for the lag between capacity creation and obviously post capacity creation you need to kind of like go through the entire sales cycle. So all of that takes like time essentially.
Understand. So this 150-200, which is 18 months time period which we envisage, whether all the orders are placed or how one should think about it?
No, not all the orders are not placed. So basically, like we also stagger our orders. So typically what we do is like we place an order, get the delivery, then place another order after the first delivery has been received. So sometimes there can be a bit more overlap where we say that, okay, speculatively we would place more orders even before receiving the delivery, but that happens rarely.
Understand. So whether we are fully funded for this 150-200 crore capital investment plan, or we may require some kind of funding?
No, this we can do like 150 to 200 overall infrastructure capex expenditure. Like we can fund it through debt and internal accruals.
Understand. Thank you, sir.
Thank you. To ask questions, you may please press star followed by 1. The next question is from the line of Pratik Chaudhary from Samartha Capital. Please go ahead.
Sir, this you just said that the 150 to 200 crore spend that we are planning, out of this, only some part we have already given in as orders to our suppliers. What would that percentage roughly be?
Say broadly about 30%, 30 to 35%.
Is the orders we have already given for our expected CapEx.
Yeah.
And you were saying something, sir? I cut you in between.
No, please go ahead.
So when whenever we get this delivery for, and then for the next set of order, would we be much behind as far as, because the queue with the suppliers for the Indian geography must have filled up beyond what the supplier can fulfill. So would that materially impact our chances of getting the next set of orders whenever we put in that order after we get the first order?
So like you can only plan ahead. Like basically you can't predict what would happen. So like we can plan as well as we can. Now it could multiple things could happen. Like so your overall sales cycle could delay, contributing to generating the entire amount of ARR from what you already have by the time the next order comes in. Or you could be like waiting on that order and you have customers in the queue waiting for you to kind of like fulfill the demand. So it is like very, very hard to predict these things. But it's all about like kind of like being there and like kind of like doing it in the way where you feel that, okay, this is the best course of action for the company.
And what is the sales cycle as of now in terms of, would you have a complete deployment of your, as in full utilization of your equipment from day one?
So that never happens. So there is always a time to inform the customers that yes, you have the capability to deliver something. Then the second part is like obviously the customers would take a bit of time to kind of like do a proof of concept to kind of like start using it. So overall, like we've always taken like something like a 6-month cycle from the day you have put up a deployment to where you see the significant uptake from that deployment. Like that's like a 6-month period.
But I mean, given
the entire uptake could very well be like anywhere between like 9 to 12 months as well.
Mm-hmm. But since we were hearing a lot about very major shortages in H100 and kind of SKUs, and we were hearing that a lot of these have been pre-booked. So is that not the case with you as well? Have your clients not pre-booked the 30% order that you have already given to your suppliers?
See, typically the first people who are placing the orders are all the bigger cloud kind of operations. So it is like, in a way, like a projected demand from the customers, right? So I think somebody asked the question that like last year you spent X amount on infra. This year you are spending about 7 or 8x, or that's the plan to spend about 7 or 8x. So it's similar everywhere in a way, where you are obviously looking at like the overall demand in the market. Now, overall demand in the market doesn't mean that like the sales cycle is going to get shortened. Like you still need to kind of like get a customer to do a proof of concept for them to see that yes, they are getting the value out of something. So that cycle will not shorten. You may be able to do many more customers over that set of POCs essentially. You see my point, right, Prateek? Like that, like if yesterday you had like smaller amount of capacity, you were able to do a lower number of POCs, but it would take like a certain number of weeks or months to kind of like get the customer onboarded onto production, where they start paying for it. And today, like if you have built more capacity, you are again doing additional larger number of POCs. But the amount of time it organically takes the customer to kind of like try your services, convince themselves that the proof of concept is successful after looking at the numbers of performance and outcomes that they were expecting going into production on that cycle is still there.
Right. The last question for this 30-35% order that you've already placed. In your rough estimation, in how many months do you expect to take delivery of the same, roughly?
See, I think like in this quarter itself, like most of out of the 30-35%, I think like about say 70-75% should come in within this quarter itself.
Okay. Okay, sir. Thanks a lot.
Yeah.
Thank you. Participants, to ask questions, you may please press star followed by 1. As there are no further questions from the participants, I would now like to hand the conference over to the management for closing comments. Over to you.
Yeah. Thank you everyone for participating in this earnings call. If you have any further questions or if you would like to know anything more about the company, please do reach out to our investor relations managers at Valorum Advisors. Thank you once more, everyone, and a good day to everyone.
Thank you, members of the management. Ladies and gentlemen, on behalf of E2E Networks Limited, that concludes this conference. We thank you for joining us, and you may now disconnect your lines. Thank you.